I want to now turn to the second part of this class, which is risk versus reward. And I think this is a pretty basic idea, but there are some subtleties that are important, particularly as we start thinking about investing in biopharma assets. So we know that the basic approach to valuing assets is going to be NPV analysis. We're going to focus on the present value of revenues minus the present value of costs. And if that's positive, we're going to take the project. If it's not, we're not going to take the project. So the challenge is that in reality, it's not nearly so simple to do that, even though conceptually it seems straightforward. And part of the reason, as we discussed, is that it's really hard to get a bead on what the costs and revenues are. Now, you might think that cost should be easy, right? So whatever you're spending. But that's not true at all, because not only with BirdPie, we know that the costs of various biomedical R&D items can change over time, but there are certain technologies that we don't even know exists that might require additional investment in plant and equipment. So it is challenging to do this, but as I said before, it doesn't mean that we can't. It's hard to do it, but this is exactly what financial markets were made for. This is what finance does all the time with all sorts of crazy technologies, including technologies that today seem obvious, like social media. Who would have thought that Facebook could be a multi-billion-dollar company? But in fact, it is a technology that some people had the presence of mind to invest in, and it's incredibly profitable. But if you tried to forecast what the revenue model was for Facebook 10 or 20 years ago, you'd have a very hard time. So financial markets and services allow us to address these kinds of challenges. That's what finance was made for. In order to do that, we actually have to measure risk and reward. And we're going to use a very basic measure to start with. The basic unit of account is return on investment. This is something, again, I think all of you understand very deeply. But I want to go through and unpack it a little bit because we're going to have to change our definition slightly when it comes to biomedical projects. By the way, the other thing I wanted to mention is that over the course of the last couple of classes and the next few, I'm going to be asking you to switch hats in the midst of these various different considerations. Meaning, sometimes I'm going to be asking you to think about the issues from the perspective of the biotech entrepreneur. Sometimes I'm going to be asking you to think about it from the perspective of a biopharma CEO, sometimes as an investor, sometimes as a patient. In fact, we are all of the above at some point or another. And so in order for us to be able to try to address some of the challenges of this industry, we need to see those different views. So right now, I'm going to ask you to change the perspective and start thinking about things from the perspective of a shareholder or an investor in these technologies. And to do that, we want to measure the rate of return. Money in versus money out, we already know that the basic idea is when you take the ratio of the two, you will get a sense of how well or how poorly you're doing. The gross rate of return is cash out divided by cash in, right? Cash on cash returns, 3x, 4x. The net rate of return is going to be that minus 1. And the annualized net rate of return is the gross rate of return to the 1 over nth power minus 1. And the cumulative return, of course, is just the product of the gross rates of return. These are the kind of things that as shareholders, as investors, we're going to be focusing on. So we need to calculate all sorts of characteristics about these returns. Specifically, we want to focus on both risk and reward. So risk and reward go hand in hand, as we saw in the very first class and as you saw in introductory finance, but I want to unpack it a bit more. I want to focus on the fact that returns, by definition, in the real world are unknown. They're random variables. And so we need to model them and somehow, and typically the language of probability and statistics is what we use to try to capture these kinds of fluctuations. So I want to start with the basic observation that this is how we think about returns. It's a histogram, a distribution. And so as an investor, you're presented with this. Now the problem is that most investors are not from MIT. So when they look at this, they say, well, that's a pretty mountain, and that's about it. It doesn't help. So we need to reduce things in a way that is interpretable by the vast majority of investors. Otherwise, you will lose that particular set of investors and focus on a much narrower, although albeit intelligent and elite group. We want to be able to appeal to a broader set. And so we calculate various different features of this mountain. For example, we might want to take a look at the mean, the middle of that distribution, or the median. That's one statistic we can calculate from this distribution, one way we can measure its features. Second, we might want to take a look at the 75th percentile. We might want to look at really bad outcomes, which is the 5th percentile. Those are losses, clearly the left tail of the distribution. And so these various different measures are ways that we can get intuition about the particular risk and reward of these unknown investments. It's a way that we can communicate with investors to provide them with a narrative of what they're buying into. For the most part, when it comes to reward, finance theory uses the expected return, the average return. On average, what am I going to get? What is my expectation? Now, that's not at all a trivial choice or an obvious one. I can give you all sorts of arguments for why that could be misleading. In fact, we're going to see why that could be misleading when we talk about focusing on multi-period investments using venture capital models and IRR. It's not going to be easy to calculate these kinds of statistics for returns that have yet to be realized. But anyway, we're going to use that for now. That's what you used in introductory finance. And now, what about risk?